joined today by our Head of Equities Research covering the commodities stocks. And I'm joined here by Matt Hodge. Matt, thanks for your time today.
No worries, Glenn.
Now, we're talking about the miners, and one of the key points that you've made in this report is that our view on the iron ore price is that it's not going to stay higher for long.
Yeah, that's been our view for a while, but the price has continued to defy that reality. So there's been a couple of reasons for it. The Vale tailings dam incident, pretty well known, the cyclones in WA. So we think that there's at least 100 million tonnes of productions come out of the market, which is 1.8 billion tonnes. But arguably a bigger driver has been China. So we've seen an unexpected second order impact of the trade war with the US. So China's gone back to the old playbook of borrowing more money, investing in assets it doesn't really need to build, and that's consuming steel. So steel production year to date is up 10%, which is huge, right? The rest of the world is down. Production from Vale will come back. It's just a question of when, and it might not be in 2 to 3 years. It might take a little bit longer than that, but it will come back, and that's pretty meaningful. The price is so far ahead of the marginal cost. I mean, you look at the production cost for BHP Rio Fortescue, it's close to $20. The price is 120. Iron ore is not rare, so there is a risk that new production will be incentivised as well. We've seen a little bit of that with Fortescue adding.
And also, in addition to the iron ore price being high, the share prices of the producers as well have been pretty staggering, really, I guess you could say, over the last. I mean, Fortescue, I think, has returned a huge amount in the last 12 months when you look at that. Again, do we have the same view that's I guess that's predicated on the fact that iron ore price is high?
So Fortescue's got the most leverage and exposure, so it's pure iron ore. It's also, when you include the discounts, it's higher cost. So we've seen, Fortescue is getting a discount on the price, and I think at one stage it was below $40 a tonne they were realising, and the index price was around 60, and now they're getting something closer to 100. So the price for BHP and Rio is double, but for Fortescue it's 2.5 times. So their margin is improved dramatically, and they weren't making great margins before. So that's where the leverage is. It is meaningful to the valuation for them. I guess our quibble is we just don't think this level of earnings is any way sustainable, or the dividends. The last time people were looking at resource plays as dividend yielding stocks, you have to go back to pre-GFC and that kind of heady period of 10, 11, 12, 13, when these stocks were making really good money. So I think seeing resource stocks on low PEs and high yields is generally a signal that they're expensive, not the other way around.
Another point that you've discussed I know you've said this in relation to Fortescue, but there's this distinction between the high grade producers and the lower grade producers, and can you explain for us a bit about how that dynamic works across the some of these different miners you've discussed in this report? Yeah,
I'll try and give you the short version. So when steelmaker margins are high, they want to produce more tonnes of steel because that's how they make the most money. They're less sensitive about the price of the inputs. When steelmaker margins are low, the steelmakers care about the price of the inputs, and they're trying to reduce that unit cost of raw materials. What that means is, for Fortescue, when steelmaker margins are high, the discount for that lower grade product is high. And when steelmaker margins are low, the discount for the low grade product is low. So it's kind of counterintuitive. If the steel mills are making less money, Fortescue gets a better price. It's kind of odd that way. But it's not the biggest driver. The biggest driver is general market balance, and that's been the primary mover of the price.
By market balance there, do you mean the balance of the iron ore?
Supply and demand,
okay.
Yeah.
And does that distinction there, does this just come back to why people, or how people can be selective in terms of which miners might be doing better than others, and beyond just looking at the market cap?
Yeah, I think more important is the commodity exposure in this case. And we've seen base metals have sold off a bit. So we've seen some, we don't see a lot of overvaluation at all amongst the base metal miners, and even some pockets of value, like Oz Minerals is undervalued. We've seen Iluka, that was on our best ideas list in May, return 27% by the time it was taken off at the end of last month. So that's done well. We think the market was mispricing a few things there, and that's kind of played out. And now it's kind of the coal stocks where value is emerging. So there are a couple of reasons for that. So on the demand side, it was a pretty mild Northern Hemisphere winter. Mm-hmm. So demand was a bit soft. We've also seen more production of energy from other sources in China, and China's increased its own production of coal as well. China is a huge producer of coal, and the export market by comparison is a drop in the ocean. Newcrest was another stock that we'd been positive on for a long time, and that's well and truly played out now, and we've seen a lot of concern about geopolitical risk, economic risk, and the stock itself has actually had a really good run in terms of improving the reliability and production and costs at its operations. So that's been a good story, but it's played out now. We think it's relatively overvalued. That's not to say it won't get more expensive.
Sure. Well, and of course, people can look at the full report that's available if they're a premium subscriber.
Yep, or if they're on ARC as well.
That's right. Yeah.
Yep.
Great. Thanks for your time today, Matt.
No problem. Thanks, Glenn.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.